You go in the car garage and looking at the Porsche and you say to the guy behind the counter, I want to buy that red one, and you say, how much is it? And if he said to you, look, well, you can buy it, but I can't tell you the price of it till after you bought it, and it'll be tomorrow. You know, you just never would do that. So why in financial services are we in that sort of spectrum?
Hello, welcome to Invest Like a CEO, and we have the co-CEO and co-founder of Han ETF with us, Hector McNeil. Thank you for coming all the way to be with us. I know you've been traveling a lot. How are you?
I'm all right, and yourself?
Yeah, good. Not as good as you, though. You've just been to Vegas.
Yeah, I've done a bit of travel, Seattle, Vegas, Miami, and DC.
And much of that is also down to the ETF conference season, right?
Yeah, no, that's right. I mean, this part of the year is very much ETF conference. There's a massive conference in Vegas, you know, which is probably the landmark event of the year, the exchange event. And then there's the pretty much a modern new one, Future Proof, which is sandals and shorts on the beach, just near Muscle Beach on Ocean Drive in Miami. So it's a terrible world, this ETF business. You know, as a lad from Middlesbrough, it's a little bit different than that, that's for sure.
Now, talking about that and, you know, lad from Middlesbrough, you've had such an amazing journey with so many twists and turns. Give our clients and those watching this a quick synopsis of your career.
Yeah, I've been very lucky, to be honest. I mean, I started in the city in 1989. I had a very good relationship with my brother-in-law, who he was a teller at HSBC Bank in York, came to London, ended up being head of mezzanine finance at Ange, you know. So, and he said to me, look, your personality, the way you are, the city would be a great place for you to come, you know. And I was at university in the north, thought, what should I do? And applied to the London Stock Exchange and got a place there, and got to be a graduate trainee. And, you know, the London Stock Exchange is a great place to learn because you're centre of the universe there. And, you know, I had time there, then went to BZW, went to Morgan Stanley, and then set up an exchange called Jyway. And then my journey started in the ETF world. I went to a firm called Susquehanna, who are one of the biggest ETF market makers in the world. Set up their ETF capabilities from scratch out of Ireland. And then we started to try and market that to ETF issuers. And that's when I got into the asset management side of the ETFs and became one of the founders and owners of a firm called ETF Securities. That was my first sort of jaunt into the ETF industry. And we were pretty much the most successful ever privately launched ETF business in Europe. Took that business from 0 to 36 billion at its peak. You know, we were in places like Tokyo before iShares, and we, you know, set up in the US. And most people come from the US to Europe rather than go from Europe to the US. And we were very, very famous for creating the first gold ETF in the world. So we created the first gold ETF in the world in Australia, brought that to London, which is still a product today, which is Gold Bullion Securities. In fact, we've just done a video on the creation of that, which people can see if they want to see how the first product was ever created in that space. And then the GLD came 12 months after that. And everybody thinks the GLD was the first gold ETF in the world. You know, it's 140 billion, you know, massive product, but actually it wasn't. GLD in Australia was. And then from ETF Securities, I started a business called Boost, which is a short and leveraged firm, which after about 3 or 4 years, and we got about $1 billion of assets, a firm called WisdomTree came in, which most people probably would have heard of in the ETF space. They want to come to Europe, but didn't have a team, and they said to us, look, you know, can we do something with you guys? So we did a JV with WisdomTree, and we set up a business called WisdomTree Europe. We rolled Boost into that, and then we co-owned that with WisdomTree, built their platform, and then they bought us out of that after about 3 years. So then came Han. So Han's our fourth and hopefully last ETF business. That's the
never say last. There might be another one in you.
Yeah, well, I still think we've got a long way to go with this one, but it's really going well. So
I mean, clearly the growth metrics are incredible. I mean, I looked this up before you came. European ETFs, you know, growing incredibly, 41% in 2025 to $3 trillion in AUM. And some numbers out there, EY, for example, saying that this could, you know, reach 6 trillion in Europe by 2030. What do you think is behind this growth? Is it just, people having a thirst for wanting exposure, but easier in an easier wrapper? Is it the fact that, we're seeing the youth of today, the younger generation, want to enter the market with greater ease, right? Like how they buy stuff on Amazon. What are the main drivers?
Yeah, it's probably all of those things, really. What's really interesting about the ETF industry is it's sort of had a CAGR of about 20-25% since day one. I mean, you even mentioned 3 trillion of assets. Actually, we calculated yesterday it's 3.6 trillion today. So I think that 5-6 trillion you mentioned is going to be blown out the water. Because ultimately, the global market's growing at 20-30% a year. I think Europe, the first time ever, outgrew the US by about 50% growth rate. Obviously, you've got to think that Europe's double the population, similar wealth demographic, same issues, same problems. We're just sort of 3 to 5 years behind. So I think, the global AUM, I think currently is about 21 trillion. I mean, when I started in ETFs at Susquehanna back in the early 2000s, I think Europe was about 20 billion of assets, and globally it was about 100 billion. And we didn't think it was small back then, and now we're at 20 trillion plus and growing, at 20-30% a year. And I think you're exactly right about what's driving that. I call it the ETF black hole. Everything's getting sucked into that world. Initially, it was just plain beta, plain index products. Then it was smart beta. Then it was thematics. Then commodities, and then you got active equity, active fixed income, and now you're seeing even defined outcome, sort of structured product type environments all coming into this space. And there's even talks about private capital, private equity coming into the markets as well. I mean, you're starting to see some early versions of that. And I think basically it's anything that can be provided in a liquid form in the wrapper. So as long as you can be able to hedge it, because obviously you can trade it real time, effectively a real time NAV as soon as the market's open, then that's a story. And in terms of the youth, I think that I actually class myself as a bit an ETF Mooney. So I class myself as a little bit of a cultist when it comes to ETFs. But obviously the Moonies were a cult in the 70s, and I think the same is true with ETFs. Is I always say to clients, because Han ETF is unique on the basis we're a white label provider. So we work with third-party asset managers who want to issue products but don't want to invest in all the infrastructure. So we have 30 different asset managers on the platform. I think the whole ETF market in Europe is 150, and we've got 30 of the market on our people like Jupiter or Guinness or Otto or KBC, DZ Bank, these types of people. And what I always say to these clients when they first come to me, I said, look, it's the first time my mum is going to be able to buy your product. So it's not just the youth of today, it's everybody. And she can buy one share for the same economics. Yeah, same exposure, same economics as Fidelity can buy 1 million shares. So the democracy of the wrapper is just perfect from that perspective. I mean, if you think about what we did last year, we did the first European cat bonds, catastrophe bond ETF, and that's only been available in mutual fund form up until now. So there's no way my mum could have got access to that, and I also say if you go the other end of the spectrum with my kids, if I said to my son he had to, fill a form out and attach a check and wait a week to see what he gets back, he'd say, what the hell are you talking about, Dad? There's no way I'm doing that. I even use the other analogy, if you go in the car garage and looking at the Porsche and you say to the guy behind the counter, I want to buy that red one, and you say, how much is it? And if he said to you, look, well, you can buy it, but I can't tell you the price of it till after you bought it, and it'll be tomorrow. You just never would do that. So why in financial services are we in that sort of spectrum? And I think the sort of convergence of, people like IG from the electronic trading perspective, the platform perspective, the immediacy of the ETF wrapper that you can trade at any time during the day, buy and sell it. The market opens at 8, you can buy it, then sell it again 1 week past 8. It's up to you. And then obviously the whole information spectrum that's available to people, whether that's social media, the Reddits or the Discords or X, you've got this information flows out there that people have never had in history. That sort of convergence of that e-commerce is what's driving this whole story. And it's an industry that's massively innovative. It's different things. I mean, the last 2 weeks we've come out with the first drones ETF in Europe.
Yes, I saw that.
Yeah, first Ukraine reconstruction ETF. These are just things that you could only have dreamt of 25 years ago.
We're going to talk more about those ETFs and the types that your company has done. I think most people watching this will be just astounded by, you know, the growth that you've seen, and obviously, you know, it's almost every theme. So they'd love to know, Hector, how you invest personally, right? You've got all these eyes on the ground in different sectors. How do you decide where to put your money to work?
Yeah, I'd say we you know, there's never a shortage of ideas in the business, you know, and there's a lot of blurred lines between what I invest in and what my company produces, because obviously, you know, because I'm such a significant owner of Han ETF, effectively, if we issue a product that's successful, it's part of my investment portfolio, you know. So, for example, I'm a big believer in gold, you know, because it's you know, the purest of insurance assets you
Even
can get.
what we've seen with the markets recently and the fact that gold plummeted after the conflict started.
I'll tell you an interesting story. So when we created the first gold ETF in the world, what price do you think gold was in 2002?
Oh, we're testing you now. 900?
$365 an ounce, right? So gold's gone up effectively 12, 13 times since we brought the ETFs out. I think a lot of it's been down to ETFs, because before ETFs came along, you know, people had to buy coins or bars, stick it under their pillow or, you know, in their safe or whatever the story was. And, you know, when gold ETFs came out, you know, that was the first time people could coherently buy in size at spot price in the gold market. So I always look at like my exposures in the company as well as what I've got in my own investments. And I'll rarely, being an ETF man, I'll rarely buy a single stock now. I just think the ability to be able to diversify, to be able to get that sort of liquidity, you know, be able to buy in people's expertise, whether it's, you know, index expertise or active management expertise, you know, is going to be a lot more coherent than me spending a lot of time trying to figure that stuff out as well. So, you know, a balanced portfolio, big believer in pounds cost averaging, you know, because I think that's a really...
You're a time the market rather than time in market kind of guy.
Yeah, well, I think you never get in at the highest and you never get in at the lowest, you know, and over time, that sort of compounding effect, you know, will pay you dividends. Funny enough, I first got into that with investment trusts when I was very young. You know, when I was first in my career, when I started the London Stock Exchange, I really liked the investment trust sector, and they offered, you know, what's actually revolutionising the whole retail market in Europe, these savings plans. I mean, I think in Germany alone, there's 50 million new savings plans over the last 5 years, almost exclusively going into ETFs. So basically, once a month investment, 500 to 1,000 euros, goes in almost exclusively into ETF portfolios. So that's sort of euro cost averaging. And investment trusts always had that. So you could always invest. You know, I used to like things like Clement Flavor House, Clever House, you know, all those types of things. You know, that trust has been around for 100 years, you know, which is insane really when you think about it. An investment vehicle being around for that long and still relevant. And I used to like the discounts that were there. So I used to invest on a savings plan through that sort of mechanism. So it's a natural thing for that to come to the ETF market. Because ETFs essentially the modern version of investment trusts from that perspective. So I think you know, I'm a big believer in that because ultimately, you know, my business takes up all my time, you know, so I put all my time and effort into that. So, you know, I don't want to speculate, because usually when I speculate, I haven't put the time and effort that you need to be able to do that and monitor it. I mean, we were discussing it earlier, big believer in limit orders, you know, so you put some discipline around what you accept in terms of your losses.
Lots of rules.
Exactly. And that's great, right? Because ultimately that stops you impulse selling or buying, doesn't it? You know, because ultimately, you know, my view of the world is that, you know, if I get some information, I'm probably going to be the last person to hear about it, or the bots or the algorithms are going to get to it a lot quicker than I am. So from that perspective, I think you know, having that sort of approach is a lot more coherent. You know, probably gives you a lot more downside protection. You know, and obviously over time, I think it was Einstein said that compound interest was the eighth wonder of the world, right? You know, and there's a lot to do with that. You've probably seen it yourself as well. This huge online community, especially in the passive income space, where, you know, ordinary people are sort of realizing the social welfare system isn't going to be there for them in the future, so they want to actually put their money to work. they won't buy a coffee or a bacon sandwich in the morning, and they'll invest that money and they'll aim to retire at 40. I think there's even a community called the FIRE community.
Yeah, what on earth you would do after 40 with nothing, if you've retired by then, I don't know.
Well, at least it gives you options, doesn't it? I mean, you can carry on, or you can go live in the Bahamas or whatever, or Norway with your gun and your gold and you're living off the grid or whatever it is. But the point being is you can take charge of your own destiny, because I think, even in Europe, there's a sense that the social welfare system's not there like it was 20, 30 years ago. So you've got to take much more charge.
And inflation is, hitting the roof. Do you ever have kickers in place? You have kickers. When I say kickers, I mean, all bets are off. I need a different strategy now. Do you move your allocation at all, or do you just drip feed and rely on compound interest?
Yeah, no, I think I've been fairly consistent, to be honest, because I do think, I've been through 92, I've been through 2008, seen
the wars.
Yeah, seen the wars quite literally. And I think the view is that, if you don't panic, you probably will be able to take more money off the table in the long term. You just got to hold your breath a little bit. What I've done slightly differently in the more, say, probably last 5 to 10 years, but it's probably because I've been more in a position to do it, as I do keep some cash. So I do get into the market, when there is downturns like this, and but I'll do it at the portfolio level. I won't try to guess the market. So if I'm running a sort of a more aggressive portfolio as part of my holdings, then I'll probably wade in through that aggressive portfolio. Funny enough, I use the IG Smart portfolios. Actually. So there you go. So, I do keep some money on that basis that I would sort of put it to work, but that will be across a whole portfolio. And that's, again, the other thing that ETFs give you that ability to do, is to, rather than just, stock pick or sector pick or equities versus fixed income versus commodities or alternatives, you can just wade in through the full portfolio, and you can sort of risk weight it, from that sort of conservative portfolio to that aggressive portfolio. And then you can just pick that sort of route, and that's how I would do that. So I try to keep a little bit of cash, in order to take advantage of those dips, on the basis that if I'm going to hold steady on my portfolio, I'm going to take that dip anyway, but the cash can take advantage and I stay in the market from that perspective.
Buy it at a discount.
Hopefully.
Yeah.
Hopefully.
Yeah. So, back to the ETFs now. There have been so many cool ones recently. Where's the next leg of growth? Where are the pearls, if you like, that have not yet got an ETF wrapper? What are you looking at? Yeah,
I think the biggest look, probably one of the biggest successes, particularly from a retail perspective or a broader investment-based perspective, has been thematic ETFs, and I think thematic ETFs resonate with people because it's very easy for them to sort of have a view. And, for example, I always say my mum would have a view on e-commerce, or she'd have a view on healthcare, or she'd have a view on transport, because she's using that every day. Where if I talk to my mum about factor investing or, something a little bit, we love all our technicalities in the financial services. So thematics resonate quite well with people. And I think as long as investors see that as a satellite position in their portfolio, they've got their core portfolio and they've got, say 10% of their investments, or even 5% of their investments they can use at the edges, with these sort of thematics, then that's what I see as probably being quite interesting from a retail perspective. So, and I think there's been trends in that, whether it's sort of technology related themes like AI or cloud computing or data centers, whatever, or you've got the commodity areas. We have a big range of uranium and nuclear products, which I think are very interesting. Because obviously, we need to move to, you're seeing this at the moment with the geopolitics and the rise in fossil fuels. The way you get energy independence is through renewables, because your wind is your wind and your sun is your sun, and you're
moving on to another energy complex.
Exactly. But obviously the wind doesn't blow every day. So actually nuclear is a pretty much an underpinner to that side, and it does give you energy independence from that level. But I do think one of the biggest interesting areas for thematics today is geopolitics.
Yeah. So I was just going to say, you've got NATO, which I had exposure to, but I sold all of that after the first quarter.
You sold one of our ETFs?
I did.
You never told me that.
Because I go to the DSEI and I speak to all the defense people, and last year, might be different now, but last year it was clear after the first quarter that all the funds that were to be allocated were already allocated.
Yeah.
But also I'm interested in Quad. You've also launched that one. Drone, we've talked about that.
Yeah.
Do you think that sector is overdone now, or do you think there's more to come?
No, look, I think it's very early days, actually. I mean, Quad, funny enough, is the Asia Pacific defense ETF. It's the only one in Europe, but actually it's the best performing defense ETF in Europe. It's a better performer than Europe. It's a better performer than global defense, and the reason being for that is you've seen, great movements in price movements in Korea and India, for example, and there's no doubt that Trump and his regime are going to focus much more on that area, as a ballast to China, so they're going to be under pressure to get to that 5% like Europe was. So it's just really a year or two behind that. Plus as well, you've got countries like Japan. When you look at Japan geopolitically, it's surrounded by Korea, it's surrounded by Russia and China. It's got no choice but to do that. But it's still got the third largest navy in the world of Japan. But then you've got Australia, India, New Zealand, all these other countries are going to have to get to the table on that perspective as well. So I've got no doubts that's going to be a story. And we're in this scenario as well where, we talk a lot about the Cold War and we talk about hot wars, but what we don't talk about warm wars. And we're in that sort of warm war environment now for me. We're in that sort of where there's lots of global battles going on, but, then you've got an overlay where we're probably in a hot war when it comes to cyber and technology. We haven't even started talking about space, and there's no doubt that people are still spending as if there's a peace dividend, so that 2.53% is in an environment where, everything's benign and nothing's happening. So obviously governments can't quite react as quickly as they need to in terms of spend from that perspective. But during the height of the Cold War in the 50s, 60s, Britain was spending 7% of GDP on arming itself. And I think that's going to be a reality, that we're going to be very close to that 5% across the world, what we would call the free world. So I think geopolitics is going to be a huge driver for that. And then, obviously you talked about drones. I mean, drones is interesting from a number of different perspectives. I think, because you've got this crazy scenario, this asymmetric war that's going on in the Middle East at the moment, where Iran's chucking, $30,000, $40,000, $50,000 armaments against $2 million, $10 million missiles, and obviously that's got to change. It's actually quite interesting as well, because I think it sort of really plays into Ukraine's hands, because Ukraine has been a petri dish for all the major defense parties in the world. And, they're now probably the world experts when it comes to fighting asymmetric wars. And, you're hearing about this scenario where, Ukraine has got troops in the Middle East now helping the Americans. Zelensky's doing a event in Miami at the moment, where they're talking about how Ukraine can help the US government.
They've just shown everyone how you can really arm up, but from a very domestic level as well.
Needs must, right?
Yeah.
I mean, if you look at it, if we roll back the clock to when Zelensky and Trump were in the White House, and he shouted at Zelensky and told him he hasn't got any of the cards. Well, he's got a lot of the cards now, so that's changed a lot. I think actually from a geopolitics perspective, and actually when you look at the Ukrainian army generally, I mean, it's 1.2 million troops. It's the fifth largest army in the world. Now, everyone thinks it's quite a small army, but it's not. So when you combine that with Europe in terms of capability, in terms of manpower and units, actually Europe has by far the biggest army in the world, even bigger than the US. Maybe not the same spend as the US, but we're not going to be far off that. So I think there's a huge amount of geopolitics, and actually what's great is through ETFs you can get exposure to that, whether it's the drones ETF, whether it's Ukraine reconstruction, whether it's NATO, whether it's Quad. I mean, we've even got a covered call defense product as well now, where you can participate in the defense stocks, growth of those, but also you're getting through the options market, you're getting a 20% plus yield on those stocks, and where else you're getting a 20% yield in the marketplace in today's world. So I think that's really where and then I think the other big trend we're going to see is the structured product market coming onto the ETF market. So where in the past you'd get a bank structured products around downside protection, upside participation, or yield products through derivatives, you're going to see that coming on the market. I mean, that's been very much the prevalence in the US.
It was growing, and then we had the GFC, right? We had this derivatives, we had the options products, and then we had the great financial crisis, and it went away for a bit.
I don't think it ever came to the ETF market though, because this is the difference now. And I think the ETF wrapper generally is a lot more robust than the structured product market. If you think about structured products, they're all issued pretty much by banks, and essentially you're basically getting unsecured credit against the bank. It's done off the bank balance sheet. With an ETF, it's always bankruptcy remote. It always holds assets. Even if it's got derivatives, it holds collateral against that counterparty risk. So the ETF wrapper is a lot more robust and a lot more transparent than those structured products. And obviously, you've still got that arbitrage and liquidity mechanisms that ETFs have. Structured products, you can't arbitrage it. So if the bank misprices it, the bank misprices it. There's no way you can bring that into line. So you get all those benefits of ETFs, and you're seeing this huge growth of covered call products in the US, huge growth of auto-callable products, buffer products, ladder products, and you're starting to see all those in Europe. I mean, we've got 7 different covered call products now on the platform.
Do you know my favorite thing about ETFs is, I am a big user of ETFs.
Yeah.
I just love the tickers.
Yeah.
I mean, like
tickers are fun.
tickers are so much fun.
Yeah,
I always wonder how much time do you, put in place to actually get the right ticker? Because we've seen NATO is so it's what it what it says on the tin, right? Easy to understand. But there are some other interesting ones like KIEV as well, KIEV. That's also very easy to understand. What are some of the funnier names that you've come across or thought, I wish I got that through?
Well, we've had some really good ones. I mean, the funny thing is on our European defense ETF, the tickers are Army and Navy, which are pretty cool. Then obviously with the Ukraine product, KIEV is the ticker on that. We used to have a space ETF that had YODA as the ticker. We have a bunch of products in the past that, whether it's the first gold product was GOLD. We used to have 2 times long short FTSE 100. One was SUC, 2 was a short FTSE, and LUC 2 was the long FTSE. So in terms of time, I mean, I think it's more of like an internal competition. Somebody will start the email saying, what ticker do we want for drones, DRON, and then it'll all start firing, and then everybody piles in, and then basically you get down to 4 or 5. You go and reserve those at the London Stock Exchange on the master file, and they keep those. And then when you get close to launch, you choose those. There's all sorts of great tickers. There's another space ETF in the US with UFO.
Yes.
So you've got,
there's also a ticker, UFO ticker for a single stock, and it's Alien Metals.
Okay.
Yeah.
I don't know if you saw that ETF that's coming to market from Matt Tuttle in the US, where it's basically companies he thinks will benefit from alien technology if it truly exists.
Oh my goodness!
So there you go. And there's a grifters ETF as well in the US where it tracks people who are prone to corruption in the political system. And I think there's a Republican focused ETF and a Democrat focused ETF. So you can get virtually everything in that space. I mean, you're even seeing now where even ETFs are going to come out in the US based on the predictive markets, sort of poly markets and people like that. But I would say with ETFs, there's 101 things you can do with them. We just haven't thought of them all yet.
And finally, milestones for Han ETF. What can everyone expect?
Well, we've been hoping for the 10 billion for the last last 3-4 months. Obviously, each time we get close to that, I think we got to 9.5 billion. Our orange friend in the White House says something else, and it changes the market. But we got a lot of. I think we've got 28 ETFs to launch in the next sort of 4 months. Which I think last year the record number for Europe was 38 ETFs, and iShares launched 38. We did 28 29 actually last year, but I think we'll blast through. We'll be by far the largest issuer of new products in Europe. So I think that 10 billion will go pretty quickly, and we got some pretty big clients coming like KBC, DZ Bank. We got our first big Indian client. I think we announced it today, Kotak, and we've got our first Korean client. So I think we're going to be adding about another 10 clients, and probably about another 30 products, probably get to about 50 by year end. So I'm hoping that 10 is going to look more like 20 billion by year end. That's what I'd hope.
And out of that number, I mean, it's a big number. Is there one particular one that has caught your eye, or can you reveal maybe the sector?
Yeah, well, I'm very hopeful on drones because it's a pure play. And I think there's going to be a huge amount of commercial interest in that sector as well as defense related. Very excited about Ukraine. I think that product will be, at the moment we have no Ukrainian stocks in there. We're about to add our first 2. And it has a fast track mechanism for IPOs to bring them in, because I think, it could be next week there's peace in Ukraine, and that could get sorted out pretty quickly. And overnight that product could be, $5 billion because it's the go-to mechanism for that. And I think it's a great product on the basis that it's a really efficient way for money to get invested into the capital market structure as it re-emerges in the Ukrainian sector. So I think it's a really important tool for both the private equity side of that, and because actually we do have this ability to hold around about 5% of private equity, which is very unusual for an ETF. So we could hold unlisted companies through funds that are invested in that sector. So closed-end funds we can hold in the ETF. So we should be able to get both the listed sector and the private sector in there. So I could see that happening very, very quickly. And then we have a whole raft of other products. But I would also see that the covered call products I think will do very well. We talked about that sort of passive investing community where they're looking to sort of turn their, money into working when, they always say, I want my money to work while I'm sleeping. And when you've got covered call products that are, producing between 15 to 20% yields, on a monthly basis, they pay out monthly as well. They can be real alternatives to, dividend ETFs that maybe are paying 5%. So, and you still get some participation in the upside, and you get that sort of active management that gives you that sort of yield factor from that, which is pretty unusual. So I'll see those products growing quite dramatically as well. So I think there's going to be, and I think that the bigger products we have today, like we've got $3.5 billion in NATO. I think that'll be a $5 billion product. I think our raw mint gold product with the raw mint, which is Britain's oldest company, 1,100 years old, set up by Alfred the Great to finance the Viking Wars. I mean, that's a $2 billion product now. I could see that being a very big product. I mean, uniquely, that's the only gold ETF in the world where you can redeem your gold for sovereigns, Britannias, and gold bars, and that's pretty unique. And I think people like that because it proves that the gold exists. From that perspective, plus it's sovereign backed because the raw mint's owned by the UK government. So yeah, so I'd see the sort of bigger products getting bigger and newer sectors like the geopolitics and the structured product covered call type products doing very, very well.
Thank you very much, Hector. It's always such a pleasure having you here. And for those of you that love the interview, please do like and subscribe. Put your comments and any questions for Hector below, and we will get that answered. Thank you for watching Invest Like a CEO.